Imagine you're a beginner investor and someone tells you to build a good portfolio, you need to own stocks from tech companies, healthcare companies, energy companies, financial companies, and at least 20 or 30 different businesses. You're thinking, how am I supposed to research 30 companies? How much money would I even need? Well, what if I told you there's one simple investment that lets you own pieces of hundreds or even thousands of companies all at once, automatically diversified, and it costs less than buying individual stocks? That's an index fund. And today, we're breaking down exactly what they are and why every beginner should care about them. Quick disclaimer, everything I share is educational based on my 10-plus years of investing experience. I'm not a licensed financial advisor, and this is not financial advice. Everyone's situation is different, so always do your own research and consult professionals before investing. Now let's dive in. Before we talk about index funds, we need to understand what an index is. Think about it like this. Imagine you go to a grocery store, and instead of buying individual items, you could buy one pre-made basket that has a little bit of everything: milk, eggs, bread, fruits, vegetables, all mixed together in one purchase. An index in the stock market works the same way. It's basically a pre-selected list of companies grouped together. The most famous one is the S&P 500. It's a list of the 500 biggest and most successful companies in America. Companies like Apple, Microsoft, Amazon, Google, Tesla, and 495 others. Someone already did the work of picking 500 strong companies, and now they're all packaged into one list. Now here's where index funds come in. An index fund is an investment that buys all the stocks in a specific index for you automatically. So if you buy one share of an S&P 500 index fund, you're instantly buying a tiny piece of all 500 companies in that index. You don't have to research each company, you don't have to buy each stock individually, you don't have to manage anything. One purchase, 500 companies. It's that simple. Let me show you why this is powerful. If you wanted to build a diversified portfolio by buying individual stocks, you'd need thousands of dollars, and you'd have to manage each position separately. But with an index fund, you could invest $100 or $1,000 or $10,000, and you get instant diversification across hundreds of companies. One investment, hundreds of stocks, automatic diversification. So why should beginners care about index funds? Reason number one, you don't need to be an investing expert. Picking individual winning stocks requires deep research. You need to read financial statements, understand business models, analyze competitors, track quarterly earnings. That's a full-time job. With an index fund, you're not trying to pick winners. You're buying the whole market. You don't need to be smarter than professional investors because you're not competing with them. You're joining them. Reason number two, lower risk through automatic diversification. Here's a harsh truth. Individual companies can fail, even big ones. If you put all your money into one company and it collapses, you lose everything. But if you own 500 companies through an index fund and one fails, you barely feel it. The other 499 keep going. This is what we call diversification, and it's the closest thing to a free lunch in investing. You're spreading your risk across the entire market instead of betting on a few companies. Reason number three, historically proven returns over time. The S&P 500 has averaged about 10% returns per year over the last several decades. Some years it's up 20%, some years it's down 15%. But zoom out over 10, 20, 30 years, it trends upward. This doesn't guarantee future results, but it shows the power of owning strong companies over the long term, and you get that track record without picking a single stock yourself. Now let's talk numbers. When you're looking at index funds, there are a few key things to check. First, the expense ratio. This is the fee you pay each year to own the fund. For index funds, this should be incredibly low. We're talking 0.03% to 0.2% per year. Compare that to actively managed funds that can charge 1 to 2%. Those fees matter hugely over time. Second, the ticker symbol. That's the shorthand code you use to buy it. Popular S&P 500 index funds have tickers like VOO, SPY, or IVV. And third, the fund provider.
Stick with trusted names like Vanguard, Fidelity, or Schwab. Here's a real example. Let's say you invest $10,000 in an S&P 500 index fund and leave it alone for 30 years, averaging that historical 10% per year. You'd have over $170,000. You didn't pick stocks, you didn't time the market, you didn't stress. You just bought the index and let time do the work. That's the power beginners need to understand. Let me answer the most common beginner questions. Can you lose money in an index fund? Yes, in the short term, the market goes up and down, but historically, over 10, 20, 30 years, the trend has been up. How much do you need to start? Many brokers let you start with as little as $100, some even less. You don't need to be rich to begin. Which index fund is best? For most beginners, an S&P 500 index fund is a solid starting point. It gives you the biggest U.S. companies. As you learn more, you can explore total market funds or international funds. The beautiful thing about index funds is they make the path to building wealth straightforward. Learn the basics, which you're doing right now by watching this video, open a brokerage account with a trusted provider, buy your first index fund, set up automatic monthly investments if you can, then let time and compound growth do the heavy lifting. It's not sexy, it's not exciting, but it works. And for beginners, that's exactly what you need. All right, let's wrap this up. Index funds are collections of stocks that track a specific market index, like the S&P 500. They give you instant diversification, require no stock picking expertise, charge low fees, and have historically delivered solid returns over time. For beginners, they're honestly one of the smartest places to start. They're not flashy, but they work. And in investing, boring usually wins. If this video helped you understand index funds, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing concepts this simply, using real experience from over a decade in the markets. No hype, no get-rich-quick schemes, just solid education. Drop a comment below and tell me, are you considering starting with index funds, or do you have questions I didn't answer? I read every comment and I'll help where I can. Thanks for watching, and I'll see you in the next one, where we'll dive into another core investing concept. Until then, keep learning.